Welcome to my YouTube channel. My name is Victor Whiteley, CPA, reaching out to you from our nation's capital, Washington, D.C. On this channel, I'll be uploading video regularly, providing some useful information and tips to business owners, small businesses, and also individual taxpayers. This video should not be taken as a full tax advice. If you need any help with tax planning or comprehensive tax advice, please reach out to your local tax advisor, or you can please reach out to me. We're more than happy to help. I encourage you to subscribe to this channel. We'll be uploading videos here regularly. Hi guys, welcome back to my channel. In today's video, I'll be discussing what I call S corporation versus partnership, pros and cons for you to consider. In other words, from a tax optimization point of view, what should you select as the best entity type for your business? Should it be as an S corporation, or should it continue to be taxed as a partnership? Let's look at the two entity type. So what's an S corporation? I actually discussed this very extensively in one of my previous videos that I call why you should make your LLC an S corporation. So an S corporation is a tax filing status that is selected with the IRS. So any legal entity, either a single member LLC, a multi-member LLC, or even a regular C corporation, can elect to be taxed as an S corporation, and that election is made with the Internal Revenue Service, the IRS. S corporation are pass-through entities. They only file an annual information tax return. For partnerships, so partnership is actually partnership tax return is the default tax filing status for multi-member LLC. In other words, if you create any multi-member LLC, more than one member, the default tax filing status is to file tax return as a partnership, unless the multi-member members elect to be taxed as an S corporation with the IRS. But if that election is not made, then by default they will be taxed as a partnership. So that is the comparison between both entity type. Both of them are pass-through entities, and they file an annual information tax return due on the 15th of March of every year. So you might want to ask yourself a question: how do I make a determination of what is best for my business? Should we be taxed as an S corporation, or should we continue to operate and be taxed as a partnership? That is a very tricky question, and there's actually no straightforward answer. But I think one of the best ways to look at this is to do what I call the pros and cons of what entity taxation type. So let's start with the S corporation. So what are the pros of electing your business to be an S corp? In other words, what are the advantages of having it taxed as a S corporation versus partnership? The biggest one that comes to mind that I also talked about extensively in my last video is that shareholders, employee of an S corporation can be on payroll, and as a matter of fact, they are required to be on payroll and pay themselves a reasonable salary. And being on payroll means that they can enjoy the benefits of being on payroll, being able to pay into the FICA system, that's the Medicare and Social Security. They have their federal return also withheld from their paycheck. There's no requirement for them to pay a quarterly estimated tax payment as you have for partnership. The other thing is that being on payroll allows them to enjoy the maximum benefit of retirement planning. So they, for instance, set up a 401k. The corporation could set up a 401k, and that allows the shareholder employees to have the maximum salary deferral. The second pros or benefit is that as employee on payroll, shareholders of an S corporation are not required to pay self-employment tax, and that's a big thing compared to partners that are deemed to be self-employed and are required to pay self-employment tax on any self-employment earning from the partnership. I explained that also in my previous video. Self-employment tax comes with a lot of limitations. There are many benefits that you might not be able to utilize effectively when you file your individual tax Form 1040. For instance, the child tax credit. So you cannot apply some tax credits effectively against self-employment tax. So tax credit like child tax credit, education credit, and retirement savings credit. So those credits, you cannot apply them against your self-employment tax. So in other words, like I explained in my previous videos, if you are required to pay self-employment tax on your tax return, you are not able to utilize effectively all your tax credits. The other benefit of an S corporation is what I call the tax treatment of health insurance premium paid on behalf of shareholders of S corporation. So if you have more than 2% shareholding in an S corporation, you can get a write-off deduction for any health insurance premium paid on behalf of the shareholders. And there are two ways to do that. You could have the corporation set up a group insurance policy for all the employees, and of course, the shareholder employee will also be enrolled in that policy. And any premium that is paid by the corporation on behalf of the shareholders, both the corporation get a deduction for it as an insurance expense, and also the shareholders themselves, when they file their individual tax return, they can get an above-the-line deduction for the premium paid for their health insurance policy. The only catch is that they also have to report that on their W2 box 1, just to pay federal tax withholding on it. They don't have to pay Medicare and Social Security. In the case of partnership, that doesn't apply. The other method they could use is that the shareholders themselves can actually purchase, the health insurance really from the marketplace, and they can either pay the premium themselves and have the corporation reimburse them, or the corporation can, pay the premium on behalf of the shareholders. And even when that is done, they still get a deduction both at the corporate level and also when they file their own individual tax return. Like I said before, that doesn't necessarily apply with partnership. So those are some of the the major advantages from the tax point of view. When you compare the pros and cons of an S corporation versus partnership. Now let's now look at what I call the constraints. So what are the constraints of an S corporation versus a partnership? So one of the biggest one actually is the fact that S corporation comes with a lot of eligibility requirement. So there's what I call a shopping list of which entity can elect to be an S corporation, and one of the key one is that all the LLC members that are planning to elect to be an S corporation or a C corporation, all the members or shareholders have to be U.S. resident. They have to be U.S. citizens, U.S. national, permanent residents, or at least resident alien of the United States. So you cannot have a foreigner who is not tax resident in the U.S. On a corporation, on an S corporation. The other limitation is that the maximum number of shareholders that can be in an S corporation is 100. That is not necessarily the case in terms of partnership. So in terms of partnership, yes. So if, for instance, you already have a C corporation with stockholders more than 100, then that means that electing to be an S corporation is out of the table already. And also, even as a partnership, if you're looking to, depend on your long-term plans, you're looking to grow over time, your strategy objective to grow and to have more partners, and it's probably going to be more than 100. Then that definitely means that S corporation might not be the best option for your business. In terms of other constraints with S corp is what they call number 3. I call number 3 is that S corporation can only have one class of stock. So unlike regular C corporation where you could have different class of stock, you could have common stock, you could have preferred stock. In an S corp, there can be only one class of stock. And what that meant is that from a tax point of view, all income allocation, distributed net income from the S corporation allocated to shareholders is strictly based on their shareholding. You cannot have other allocative method. So for instance, if you have an S corp with 2 shareholders, both of them 50-50 shareholding in the S corporation, any distributed net income or distribution has to be shared proportionally in accordance to their to their shareholding in the S corporation. In partnership, there are other ways, and when I get to the partnership section, I will discuss that in more details. The requirement for S corp shareholder employee to pay themselves a reasonable salary. So as I also discussed in my previous video that I called why should make your LLC an S corporation, I explained that S corp shareholders can take remuneration in form of salary and also in form of distribution, but the salary has to be deemed to be a reasonable salary. So I discussed this very extensively in my last video, and I will encourage you to watch that video. The problem with that is that there's actually no formula to decide what is a reasonable salary in the tax code, but there are some guidance, and I'll really advise and encourage you to get additional support or guidance and advice from your tax from your CPA on what constitute a reasonable salary, or you can reach out to us. We're more than happy to help. This is very, very important because there have been case law in the past where some shareholders in some corporations were a bit aggressive. They took out more income in form of distribution rather than salary, and the IRS actually went back to look at their tax returns and reclassify some of those distribution to W-2 salary, meaning that they have to hold a lot of back taxes, payroll taxes. And actually the IRS does have the power to do that. So they can go back and look at what you file your tax return from the corporation. If they felt that the salary taken is not a reasonable salary, that more were taken as a form of distribution, they could go back and reclassify those distribution as salary, meaning that you're probably going to owe a lot of back taxes in payroll taxes. So that's one of the concerns you have to think about, and you need to get additional help and support from your accountant or from your CPAs, or you can reach out to us. We will be happy to help. So I believe I've covered about 4 constraints and about 4 advantages or pros of having your entity set up as an S corporation. So let's now look at partnership compared to an S corporation. One of the biggest advantages of having partnership instead of S corporation is what I call the flexibility of how the partners can manage their affairs, and also the fact that there are less restrictions. So unlike in S Corp, where all the shareholders are required to be U.S. tax residents, U.S. citizens, that is not necessarily the case with partnership. You could have a partner in a U.S. partnership that is not a U.S. resident or a U.S. tax resident. However, if that's the case, there are other very, very important tax compliance obligation that you have. So if you have a partnership and a U.S. partnership, and one of your partners is not based in the U.S. or the U.S. tax resident, there are other tax compliance obligations, and I will advise you and I encourage you to reach out, to your attorneys, or reach out to your accountant, or reach out to us for further guidance on that. So yes, so there's less restriction. For instance, restriction in number of partners. There's no restriction, unlike what you have in the S corporation with 100 maximum shareholders. So like I said, there's more flexibility and less restriction. The other thing is that there's also more flexibility around allocation of income. So unlike in S corporation, where you can only allocate income to the shareholders based on just solely based on their shareholding, distributing net income or loss by their partnership interest, but they could also have other allocative methods depending on the agreement they have on their LLC's operating agreement. So they could have a different allocative method, and that has to be defined and clearly specified in the LLC's operating agreement. And that is one of the reasons why we always advise that if you're going to have a multi-member LLC, do not buy an off-the-shelf operating agreement. Reach out to your attorney, discuss your long-term plans, business strategy, and long-term plans with your attorney, and then write a very, very detailed and robust operating agreement. So yes, so partners can take out, they can be allocated, income, profit and loss based on other method. For instance, you could have, let's say, an XYZ partnership between 3 partners, X, Y, and Z. They all have equal partnership interest, 33.5%. Normally, if it's an S Corp, any distributive net income, profit or loss that will allocate to K1 will be based purely on that interest. But you can also look at how they run the business and say, hey, Mr. Partner X is being the brain behind the business. Maybe Partner Y just is a marketer that bring additional client or customer to the business, and Partner Z is not even involved in the daily operation of the business. All it does is just provide financial resources. Partner Z will be referred to as limited partner. At the end of the year, based on whatever is in the operating agreement, you could say, hey, because most of the contribution to the partnership was by Partner X, let's allocate the profit for the year 50% to Partner X, 30 to Partner Y, and 20 to Partner Z, whatever they decide. So that is a good thing about partnership. And as a matter of fact, I've come across a few clients that have advised when they were looking to either be set up as as an S corporation or to remain as a partnership. That was a very, very key important consideration, because if you're going to have different level of remuneration and contribution by different members or partners, that might be something that you want to consider. So that's a major one, a major advantages, compared to an S corporation. The other thing also I'd like to just mention briefly is actually more of recommendation. So from my experience and from a tax planning point of view, I know a lot of investors like to go into real estate business. So if you're looking to set up a real estate business with other your business partners, better suited to have it set up as a partnership as again an S corporation. There are a lot of tax benefits around treatment of disposition of assets in a partnership compared to just a S corporation, because in a partnership there's what we call the partners have what we call the inside and outside basis, and that could help a lot significantly as a very important tax planning tool when it comes to calculating any capital gain or loss from disposition of assets or exchange of partnership interest. So from a tax planning point of view, when it comes to real estate transaction or business, you'll be probably better off setting it up as partnership as against electing it to be an S corporation. So those are some of the key what I call pros of partnership. Now let's look at some of the constraints. Okay, so let's now talk about some of the constraints of partnership. Earlier on, I've talked about some of the pros of S corporation. What are the advantages of electing a business to be taxed as an S corporation versus partnership? I also talked about some of the constraints of having it set up as an S corporation versus partnership. And in my last section, I talked about the pros or advantages of a partnership versus an S corporation. So now let's look at constraints. The major constraint, or one of the biggest thing to consider, is what I call the potential for self-employment tax. Partners in a partnership are deemed to be self-employed and by law are not allowed to be on payroll, just like a single member LLC. But in this case now, for partners in a multi-member LLC that file a partnership return, the partners cannot be on payroll. They can remunerate, compensate themselves through combination of guaranteed payments or a regular distribution. But whatever the net income is from the business loss, it has to be allocated based on either the partnership interest or other allocative method, and they have to pay self-employment tax on that self-employment earnings. Like I also explained, because they file when they file their 1040, they have self-employment tax to pay. That might not allow them to effectively utilize all the tax credits that are available to taxpayers when they file their tax return. So that's a major one. The other thing also, is the fact that some of the deduction that S Corp shareholders have, for health insurance premium paid on behalf of the shareholders, partners don't have that level of benefit. So as a matter of fact, if the partnership pays health insurance, health insurance premium on behalf of any of the partners, that is added, to the partner's self-employment earnings from the partnership, and they have to pay tax on that. So they don't get the same level of deduction, tax benefit that they get, that shareholders get from S corporation. So that's a major difference. The other thing is that partners, when it comes to tracking and accounting for the business, their business in a partnership, is actually very, very, very crucial for partnership. So what is a basis? So partners have what they call a capital account and partnership basis in a partnership. Basis is actually put it simply, is just the cash contribution and any other properties that the partners contributed to the partnership. So to make it very simple, if a partner, for instance, has a partnership basis of 50,000 in the partnership, that limits the amount of losses that the partner can write off on their tax return because of what we call basis limitation. So let's say using my example again, if the partner has a basis of 50,000 in a partnership, and in a particular year the allocative loss from the partnership to the partner through the K1 is $70,000, the maximum you can write off that year is 50,000, and then they have to carry forward the unutilized loss to subsequent years. So that is why it's also one of the reasons why it's very important that partners have to keep very good track. And also when they are disposition of assets, they have to determine what is the nature of the gain, if there's any gain, the capital gain or just ordinary income. Keeping track of partnership basis is very, very crucial And I've actually come across a few clients that previous accountant wasn't keeping track of that. So that's a major thing that they need to keep an eye on. You need to have a very good idea, a very good accounting of your business and partnership. So these are some of the what I call the pros and cons of partnership from a tax point of view. This is just purely from a tax point of view. Like I said, please reach out to your attorneys if you go into partnership to make sure you get a very good operating agreement. Do not buy an off-the-shelf operating agreement for a multi-member LLC. So let's go back to the question we had at the beginning of this video. So what is the best entity type for you to select for your business? As you can see, it depends. There's no straightforward answers to that. So it depends on a number of factors, your long-term business plan, the operating agreement the LLC has, and also how the partners would like to remunerate themselves or compensate themselves. So you might want to look at all these factors that have all these pros and cons that I've explained earlier on, and see what is best for you. And if you need additional help or guidance, please reach out to your attorneys, or you can reach out to your your CPAs, or reach out to me. I'm more than happy to help. So I do hope you found this video very useful for you. Please, I encourage you to subscribe to my channel and hit the notification bell so that you get notified of my next video. If you have any question or comment, please submit it or send it into the comment section just down below this video, or you can email me directly, and I will see you in my next video.